Hey everyone, welcome back. All right, so today we're going to be doing a deep dive on trading styles.
Oh, cool.
And we've got a whole bunch of listener sources here, all about different approaches to trading. And, it seems like when a lot of new traders, first dip their toes into the market, they often gravitate toward day trading.
Yeah.
Because it just seems so exciting and fast-paced, and there's this promise of quick profits.
Yeah.
But some of these sources are kind of waving some red flags, saying it's not as easy as those social media gurus make it out to be.
It's definitely not as simple as, just clicking a button and raking in the cash.
Yeah.
There's a lot of risk involved.
Yeah. And a lot of these sources are really warning about the potential for significant losses if you don't really know what you're doing.
Absolutely.
So that's what we're here to uncover today. We're going to be dissecting 4 main trading styles. We've got scalping day trading, swing trading, and good old-fashioned investing.
Okay.
We'll be exploring the pros and cons of each, digging into the strategies involved, and even talking about how trading can impact your personal life.
Interesting.
You might be surprised to learn that some sources even compare frequent trading to gambling, and some even go so far as to call it an addiction.
Wow. Yeah. That's a whole other level.
Yeah, we'll definitely be addressing that. But first, let's just define these trading styles so we're all on the same page.
That's good.
Because before we can even think about which style might be right for you, we need to understand what makes each one unique.
Right.
So let's start with what sounds like the most intense one, scalping.
Okay.
What exactly does a scalper do?
So scalping is all about speed.
Yeah.
Tiny profits.
Okay.
You need to have lightning fast reflexes.
Yeah.
So imagine you're at a concert and you snag some amazing seats at face value.
Okay.
Those tickets are in high demand, right?
Right.
So you resell them right outside the venue for a quick profit.
Yep.
That's kind of similar to what scalpers do in the stock market.
Got it.
They buy and sell stocks within seconds or minutes,
Wow.
aiming to make small profits on tiny price fluctuations.
So it sounds like you'd need nerves of steel and probably like an internet connection faster than the speed of light.
Yeah, you definitely need the right tools and a high risk tolerance for scalping.
Yeah, for sure. For sure.
But let's move on to day trading now,
All right.
which is a bit less frantic, but still considered a short-term approach.
So day trading is still about making quick moves, right?
Exactly.
But instead of seconds, we're talking hours.
Yeah, precisely. Day traders buy and sell securities within the same trading day, closing all their positions before the market closes.
Okay.
They aim to capitalize on those intraday price movements, using technical analysis tools and real-time data to spot those opportunities.
Got it. So no holding on to stocks overnight for these folks. They're in and out like a well-choreographed dance.
Right, like a flash mob in the market.
Exactly.
Yeah.
And speaking of holding, where does swing trading fit into all of this?
So swing trading involves holding trades for a bit longer, typically from a few days to a few weeks. Think of it like catching a wave while surfing. Swing traders are aiming to ride those medium-term price swings, buying low and selling high as the trend develops.
Okay, I'm seeing a progression here. Scalping is like grabbing a quick snack. Day trading is a sit-down meal. And swing trading is savoring a multi-course dinner.
I like that analogy.
So if swing trading is like our appetizer, what's the main course in this trading feast?
The main course, that would be investing.
Ah, yes, investing.
It's the long-term approach where you hold assets for years or even decades,
Wow.
aiming for wealth generation through steady growth and compounding returns.
So if swing trading is like catching a wave, investing is more like owning the entire beach. You're in it for the long haul, riding out the tides and storms, knowing that over time the value will appreciate.
That's a perfect way to put it.
Right.
Investing requires a different mindset.
Yeah.
You need patience, diversification, and the ability to weather those market fluctuations without panicking.
Yeah, it seems like each style has its own tempo. We've gone from the frenetic energy of scalping to the zen-like patience of investing.
It's like a whole spectrum of trading personalities.
Right. But what about the risks? You mentioned earlier that day trading isn't as glamorous as it's often portrayed.
Right.
These sources are packed with stories of people getting burned. Why do you think so many new traders are drawn to day trading despite the warnings?
Well, I think it ties into this illusion of control.
Okay.
Because you're making decisions throughout the day, it can feel like you're actively managing your risk and steering your portfolio towards success.
Right.
And of course, there's that undeniable allure of quick profits that's often amplified on social media.
Oh, yeah, for sure.
But unfortunately, what we don't see are the behind-the-scenes struggles and losses.
Right. It's like the highlight reel without the bloopers.
Exactly. And it's important to remember that even seasoned professionals can get caught off guard by sudden shifts in the market.
Yeah, it's like thinking you can tame a wild animal just because you managed to pet it once. It's still unpredictable and can turn on you in an instant. But before we dive too deep into the dangers, let's take a closer look at the strategies involved in each of these styles. Starting with those fast-paced approaches, scalping and day trading. What are some of the tactics traders use in those environments?
Okay, well, one popular approach is momentum trading.
Momentum trading.
Yeah, it's about identifying stocks or assets, experiencing a strong upward or downward trend, and then riding that wave of momentum for a quick profit.
So they're essentially hitching a ride on a rocket ship, hoping to jump off before it runs out of fuel.
Right, like trying to time the perfect exit.
Yeah, sounds risky. What other strategies do day traders use?
Another common one is breakout trading.
Breakout trading.
It involves identifying key levels of support and resistance in a stock's price chart. Support is the price level where buying pressure is strong enough to prevent further decline, and resistance is the level where selling pressure prevents further increase.
So it's like a tug of war between buyers and sellers, and those support and resistance levels are the battle lines.
Exactly. Breakout traders look for moments when the price breaks through those levels with conviction.
Okay.
So if the price breaks above resistance, it's seen as a bullish signal.
Uh-huh.
And traders might buy in, hoping to ride that upward momentum.
So they're looking for those moments when the market breaks out of its established pattern, like a racehorse bursting out of the starting gate.
Yeah, that's a great visual.
And what about range trading? How does that work?
Range trading is a bit more conservative. It involves identifying stocks trading within a defined price range, bouncing between support and resistance levels without breaking out.
Okay.
Range traders aim to buy near support and sell near resistance, profiting from those oscillations within that range.
So they're not trying to predict huge breakouts or ride massive waves. They're content to play within the confines of that established trading range.
Exactly. It's about recognizing patterns and capitalizing on the predictable back and forth within those boundaries.
All right, we got a good handle on the short-term strategies. Now let's shift our focus to the longer-term approaches, swing trading and investing. What are some of the tactics that traders and investors use in those realms?
Well, for swing trading, one common approach is to use technical analysis to identify stocks or assets that are showing signs of a potential swing or medium-term trend. This might involve looking for patterns in the price chart, such as moving averages crossing over, or specific candlestick formations that suggest a shift in momentum.
So they're still looking for trends, but on a slightly larger scale than day traders, right?
Right.
More like catching a wave that lasts for days or weeks instead of just a few hours.
Yeah, exactly. Swing traders aren't as concerned with those minute-by-minute price fluctuations. They're more interested in capturing those bigger swings that can play out over a slightly longer time frame.
And then, of course, we have investing, which is all about the long game.
The marathon, not the sprint.
Exactly.
Yeah.
What are some of the key strategies that investors use to build wealth over time?
One fundamental approach is fundamental analysis.
Fundamental analysis.
Yeah, it involves evaluating the financial health and prospects of a company by examining its financial statements, management team, industry trends, and other relevant factors.
So they're not just looking at charts and graphs, they're digging into the company's story, their financials, and their potential for future growth. It's like researching a company before you apply for a job, making sure it's a good fit for your long-term career goals.
That's a great analogy.
But what about those investors who don't have the time or expertise to analyze companies in such depth? Are there any strategies that can help them navigate the market?
Absolutely. One popular approach is dollar cost averaging.
Dollar cost averaging.
Yeah. It involves investing a fixed amount of money at regular intervals regardless of the market's ups and downs.
So instead of trying to time the market perfectly, you're consistently putting money in bit by bit over time.
Exactly. It's like setting up a recurring payment for your investment portfolio.
It's like planting a garden.
Yeah.
You don't wait for the perfect weather conditions. You just consistently water and tend to it, knowing that over time, it will bear fruit.
I love that analogy.
And then, of course, there's the classic buy and hold strategy, which is favored by many long-term investors.
Right.
It involves picking quality stocks, tucking them away in your portfolio, and resisting the urge to fiddle with them.
Just letting them grow.
They're like those wise old gardeners who know that the key to a thriving garden is patience and letting nature do its thing. Buy and hold investors believe that over the long term, the stock market tends to go up. and that the best way to capture those gains is to simply hold on to a diversified portfolio of solid stocks for years or even decades.
Yeah, they're in it for the long haul.
Exactly. They understand that there will be ups and downs along the way, but they trust that over time the market will reward their patience and discipline.
Absolutely.
This is all fascinating stuff. We've covered a lot of ground here, from the rapid-fire world of scalping to the patient approach of buy and hold investing. But there's another layer to consider, and that's the tax man. I've heard that different trading styles have different tax implications, and those can significantly impact your overall profits. Can you shed some light on this?
That's an excellent point, and it's something a lot of traders, especially beginners, overlook. The way your trading profits are taxed can vary drastically depending on your chosen style.
So let's break it down, starting with those speed demons, scalpers, and day traders. Let's see how the tax man keeps up with those rapid-fire trades.
Before we go further, just want to pause to give special thanks to our sponsors. Palak Shah from RDSP Investments. Thank you for your generous support in making this podcast possible. SoundImax.com, official podcast microphone sponsor. We are grateful to SoundImax.com for the premium lavalier microphones, seamlessly connecting to Android and iPhone, requiring no extra apps, and delivering crystal clear audio up to 65 feet. Studio quality sound under $80. Use coupon code PODCAST for an exclusive discount. FireXBlanket.com co-sponsor. Control small home fires quickly with the Fire Blanket, reusable solution under $30. Visit their website and use coupon code PODCAST for a special discount. Thank you to all our sponsors for your incredible support.
All right, let's do it. Well, for tax purposes, both scalpers and day traders are generally considered active traders. This means their profits are typically taxed as ordinary income, which can be at a much higher rate than long-term capital gains.
So if you're making a killing in the market, you might end up sharing a bigger slice of that pie with the government. That's definitely something to factor into the equation.
Absolutely. When you're calculating your potential profits, it's crucial to consider those tax implications and decide whether the risks and demands of short-term trading are truly worth it.
Okay. What about swing traders? Where do they fall on the tax spectrum?
Swing traders often face a bit of a mixed bag when it comes to taxes. Because they're holding trades for longer than day traders, their gains might qualify for preferential long-term capital gains rates if they hold their positions for more than a year. However, if they're trading more frequently and holding positions for shorter periods, their gains are more likely to be taxed as short-term capital gains, which are typically taxed at higher rates than long-term gains.
So it's kind of like a sliding scale depending on how long they hold those positions. The longer they hold, the sweeter the tax treatment.
Exactly. And then we have the long-term investors who often enjoy the most favorable tax treatment.
Because they're playing the long game and not trying to outsmart the market on a daily basis.
Precisely. Long-term investors who hold their assets for more than a year typically benefit from lower tax rates on their gains. These long-term capital gains rates are often significantly lower than ordinary income tax rates, which can make a substantial difference in the net profits that investors get to keep.
So it seems like patience pays off in more ways than one. Not only do you potentially benefit from the long-term growth of the market, but you also get a better deal from the tax man. That's a win-win in my book. But let's shift gears a bit and talk about something that's not often discussed: the personal impact of trading. How all this buying and selling can affect your life beyond the numbers on a screen.
That's a crucial aspect that often gets overlooked. Trading, especially frequent trading, can be incredibly stressful. You're constantly monitoring the markets, analyzing data, making decisions that can impact your financial security, and that kind of pressure can easily spill over into other areas of your life, your relationships, your health, even your sleep.
It's like having a second job, one that follows you home and demands your attention, even when you're trying to relax and unwind.
Exactly. And it's not just the stress levels. Trading can be incredibly time-consuming, especially if you're day trading or scalping. That can easily eat into your time with family and friends, your hobbies, your overall enjoyment of life.
It's like that old saying, time is money. But in this case, it's almost like trading time is potentially costing you money in other areas of your life. And let's not forget the financial pressure that trading losses can create. These sources are filled with cautionary tales of people who lost their savings, their homes, even their relationships because of trading gone wrong.
Those stories serve as powerful reminders that trading losses can have a ripple effect that extends far beyond your trading account. They can strain relationships, lead to feelings of shame and guilt, and even trigger financial problems that impact your entire household.
It's a sobering thought. And it underscores the importance of approaching trading with a clear understanding of the risks involved and having a solid plan in place to manage those risks. But even with a plan, even with the best intentions, things can still go wrong. And that brings us to a topic that's often whispered about but rarely discussed openly: trading addiction.
It's a real issue and one that can have devastating consequences for individuals and their families. While trading itself isn't inherently addictive, it can become a problem if it's done impulsively, without a strategy, or as a way to escape from other problems in life.
So it's not the act of trading itself that's the problem. It's the underlying motivations and behaviors that can drive someone to trade excessively and recklessly.
Exactly. Trading can trigger the release of dopamine, a feel-good chemical in the brain, which can create a sense of euphoria and excitement, especially when you're winning trades. But for some people, that feeling can become addictive. They start chasing those highs, trading more frequently, taking bigger risks, neglecting other areas of their lives in pursuit of that next dopamine rush.
It's like any other addiction. The more you chase those highs, the harder it becomes to stop, even when it's clearly causing harm.
Precisely. And as the stakes get higher, the risks increase and the potential for losses grows exponentially. It's a dangerous spiral that can lead to financial ruin, broken relationships, and severe emotional distress.
So what are some of the signs that someone might be developing a trading addiction? What red flags should our listeners be aware of?
One red flag is an obsession with checking prices and market data. If you find yourself constantly refreshing your trading app or glued to the financial news, even when you're supposed to be doing other things, it could be a sign that trading is starting to consume your thoughts and behaviors.
It's like you can't escape the market even when you try. It's always there in the back of your mind.
Exactly. Another warning sign is neglecting family or work responsibilities. If you're skipping important events, missing deadlines, or withdrawing from social activities because you're too preoccupied with trading, it's a sign that your priorities might be out of whack.
It's like trading is becoming your primary relationship and everything else is taking a back seat. That's definitely not a healthy balance.
And then there's chasing losses, which is a classic hallmark of addiction. This involves trying to recoup losses by making bigger and riskier trades, often with borrowed money.
It's like digging yourself deeper and deeper into a hole, hoping that one big win will magically erase all the previous losses.
Exactly. And unfortunately, that rarely happens. Chasing losses usually just leads to more losses, which can fuel the cycle of addiction and make it even harder to break free.
So if our listeners are starting to recognize some of these signs in themselves or someone they know, what can they do? What steps can they take to address this issue?
The first step is acknowledging the problem. Admitting that you might have a trading addiction is crucial. It's the foundation for recovery.
It's like breaking through that wall of denial and facing the reality of the situation.
Exactly. And once you've acknowledged the problem, it's important to seek help. Talk to a trusted friend, family member, or therapist. There are also support groups and online resources available for people struggling with trading addiction.
It's like reaching out for a lifeline when you're drowning in a sea of losses and emotional turmoil.
That's a powerful analogy. And remember, you don't have to go through this alone. There are people who understand what you're going through and can help you find your way back to solid ground.
Okay, we've covered some heavy stuff in this segment. But before we move on, I think it's important to emphasize that trading itself isn't inherently bad. It can be a rewarding and intellectually stimulating pursuit if done responsibly.
Absolutely. The key is to approach it with a clear head, a solid plan, and a healthy respect for the markets.
So how can our listener find that sweet spot between passion and prudence? How can they enjoy the excitement of trading without letting it consume their lives?
One key is to set clear boundaries. Decide how much time and money you're willing to dedicate to trading and stick to those limits. It's like creating a fence around your trading activities so they don't spill over into other areas of your life.
So it's about setting realistic expectations and not letting trading become an all-consuming obsession.
Exactly. And within those boundaries, create a structured trading plan that outlines your goals, risk tolerance, and trading strategy.
It's like having a roadmap for your trading journey, so you're not just wandering aimlessly through the market.
Right. And just as important as having a plan is sticking to it. Don't let emotions or impulsive decisions derail your strategy. Trade with discipline and focus, and avoid chasing losses or making rash decisions.
It's like being a captain at the helm of your trading ship, steering it steadily through calm and stormy seas.
That's a great analogy. And remember, trading is a marathon, not a sprint. Don't expect to get rich quick. Focus on learning, improving your skills, and making consistent, informed decisions over time.
It's like cultivating a garden. You nurture it, tend to it, and reap the rewards over time.
Exactly. And don't forget to take breaks. Step away from the computer screen, reconnect with loved ones, engage in hobbies that bring you joy. Trading should be a part of your life, not your entire life.
Great advice. It's all about finding that balance and perspective.
Absolutely. And if you find that you're struggling to maintain that balance, don't hesitate to seek professional help. There are therapists who specialize in trading addiction and can provide guidance and support.
We've covered a lot of ground in this deep dive. We've explored the pros and cons of different trading styles, the strategies involved, the tax implications, and the potential impact on your personal life. And while we've highlighted some of the risks and dangers, it's important to remember that trading can also be a rewarding and intellectually stimulating pursuit.
Absolutely. The key is to approach it with a clear head, solid plan, and a healthy respect for the markets.
So as we move into our final segment, let's transition to a discussion about that fine line between trading and gambling. It seems like there's some overlap, but also some crucial distinctions. So where exactly does that line blur between calculated trading and just straight-up gambling?
Well, it's true that both activities involve risk
Mm-hmm.
and the potential for both wins and losses,
Right.
but the mindset and the approach are fundamentally different.
So what separates a disciplined trader from someone who's essentially gambling with their money in the market?
One of the key distinctions is the presence of a well-defined strategy.
Yeah.
Traders approach the market with a plan based on research analysis and a clear understanding of risk management principles.
So they're not just rolling the dice and hoping for the best. They've actually done their homework and have a method to their madness.
Exactly. They identify potential trading opportunities based on their chosen style and strategy, whether it's technical analysis, fundamental analysis, or a combination of both.
Right.
For example, a swing trader might look for stocks showing signs of a potential upward swing based on specific chart patterns or technical indicators.
They're like skilled detectives, piecing together clues to solve a mystery. Except in this case, the mystery is the market's next move.
I like that.
And speaking of clues, you mentioned risk management.
Right?
How does a trader manage risk compared to someone who's gambling?
Well, traders understand that risk is an inherent part of the game, but they take steps to mitigate it.
Okay.
They set stop-loss orders to limit potential losses on each trade.
Okay.
And they carefully size their positions, never risking more than they can afford to lose.
So they're not betting the farm on every trade. They're playing it smart, protecting their capital, and only risking a small portion of their portfolio on each opportunity.
Right. It's all about calculated risks.
And perhaps most importantly, traders are driven by logic and analysis, not emotions.
Yeah, that's key.
They make decisions based on their research and strategy, not on gut feelings, hunches, or the fear of missing out.
Exactly. It's about removing emotion from the equation as much as possible.
It sounds like they're playing chess, thinking several moves ahead, anticipating their opponent's actions, and always having a backup plan.
That's a great way to put it.
Right.
Now, in contrast, gamblers often approach the market with a more impulsive and emotional mindset.
Oh, yeah.
They might chase hot tips, jump on bandwagons,
Oh, yeah.
or make trades based on gut feelings or the thrill of the moment without a clear understanding of the risks involved.
They're more like those folks playing slot machines, pulling the lever and hoping for a lucky streak without really understanding the odds or the mechanics of the game.
Right. It's all about chance and luck.
So how can our listeners stay on the right side of that line? What are some practical tips for approaching trading with a disciplined and responsible mindset?
Well, first and foremost, education is key.
Okay.
Take the time to learn about different trading styles, strategies, and risk management techniques. The more you understand the game, the better equipped you'll be to make informed decisions.
It's like learning to drive before you hit the road.
Exactly.
You need to know the rules, the mechanics, and how to handle different situations before you get behind the wheel.
Right. And once you have a solid foundation of knowledge, develop a trading plan that outlines your goals, your risk tolerance, and your trading strategy.
So it's about having a roadmap for your trading journey, a set of guidelines to keep you on track.
Precisely. And just as important as having a plan is sticking to it. Don't let emotions or impulsive decisions derail your strategy.
It's like having a budget. You might be tempted to splurge on something you don't really need, but if you stick to your plan, you'll reach your financial goals faster.
That's a great comparison. And remember, if you find yourself constantly checking prices, neglecting other responsibilities, or chasing losses, it might be time to step back and reassess your relationship with trading.
It's like any healthy relationship. It requires boundaries,
Mm-hmm.
balance, and a willingness to check in with yourself and make adjustments as needed.
Well said. Trading can be a challenging but rewarding endeavor if approached with the right mindset and a commitment to responsible decision-making.
That's a great takeaway for our listeners.
Yeah, I hope so.
We've covered a lot of ground today. The different trading styles, the strategies involved, the importance of risk management and discipline, the tax implications, and even the potential pitfalls of trading addiction.
We've explored the spectrum from scalping to long-term investing,
Mm-hmm.
highlighting the importance of choosing a style that aligns with your individual goals, personality, and lifestyle.
And while we've explored some of the challenges, it's important to remember that trading can also be an exciting and intellectually stimulating pursuit, offering the potential for financial growth and personal satisfaction.
It definitely can be.
The key is to approach it with a clear head, a well-defined strategy, and a healthy dose of respect for the complexities of the market.
Absolutely.
So thank you so much for joining us on this deep dive into the world of trading styles. We hope this episode has provided you with valuable insights and tools to navigate this exciting but often challenging landscape.
It was my pleasure.
Remember, knowledge is power, and the more informed you are, the better equipped you'll be to make smart decisions in the market.
Couldn't agree more.
Until next time, happy trading.
Happy trading, everyone.